How to prepare your company for due diligence. If you are planning to sell your company and you are not preparing for due diligence right now, you are making a mistake. Because due diligence is where buyers stop being polite and start looking for ways to cut your price, shift risk to you, or walk away completely. This is the part of the deal where your story gets tested. And if your company is messy, the buyer will use that mess against you. So what do you need to do? First, clean up your financials. Not close enough. Not my bookkeeper knows where everything is. Not we can explain it later. You need clean financial statements, tax returns, balance sheets, and real support for revenue, margins, and EBITDA. If your numbers look sloppy, the buyer will assume your business is sloppy. Second, get your contracts under control. Customer contracts, vendor contracts, leases, loan documents, employment agreements, independent contractor agreements. You need to know what you signed, what can be assigned, and what blows up when ownership changes. Because if key contracts fall apart at closing, your deal just got weaker. Third, find your own problems before the buyer finds them. That means tax issues, compliance gaps, bad HR files, customer concentration, undocumented IP, lawsuits, disputes, and side deals you never papered correctly. If the buyer discovers your weaknesses before you do, you are now negotiating from a position of weakness. Fourth, build a real data room, not a chaotic Dropbox folder, not we'll send that over later. A real organized, complete data room. Because buyers do not just judge your documents, they judge your discipline. And if your diligence room looks disorganized, they will assume your business is disorganized. Fifth, be ready to defend every adjustment and every add back. If you are claiming personal expenses, one-time costs, or unusual items should be added back to EBITDA, you better have support, because unsupported add backs are one of the fastest ways to lose credibility. And once you lose credibility, the buyer starts retrading. Finally, get your legal house in order. Ownership documents, cap table, corporate records, equity grants, prior transfers, approvals. If ownership is unclear, the buyer is going to panic, and rightly so. Here is the truth. Due diligence is not paperwork. It is warfare with spreadsheets. The buyer is looking for leverage. You need to make sure they do not find it. So if you want to protect your price, shorten the deal timeline, and stop buyers from using diligence as a weapon, do the work before you go to market. Because once the buyer starts digging, it is already too late to pretend your company is cleaner than it is.